You ready, Hugo?
I'm ready.
All right, cool. All righty. 3, 2, 1. Hello, this is Brad Wiseman. You're listening to Real Estate and You. We're back today. It is St. Patty's Day. As you can tell, if you're watching this, there's a green hat on the table. That is not my hat. It is actually Justin Perella's hat because he's here in the studio with me. And he's dressed in all green, too. He's very, very festive today. Very festive. Are you a leprechaun?
No.
Are you sure?
No, and I'm only a quarter Irish.
Oh, okay. We want a quarter Irish. All right. So as you can tell, Justin Perella's here. We're going to talk about mortgages, get some updates. We're going to try to alleviate the scare, the doom and gloom of the rising interest rates because we just don't believe in doom and gloom around this place. How you doing?
Good. Power positive thinking.
That's right, man. Screw everybody else. We refuse to be negative.
Don't bring that negativity around.
That's right, man. That's right. So happy St. Patty's Day.
You too, man.
Yeah.
Yeah. You
top of the afternoon to you.
You're not doing anything today? You're
not today. I'm going to eat some corned beef.
Okay.
Do you eat corned beef? Hugo, do you eat corned beef? No, you don't eat corned beef?
No.
Okay. Well, we're going to do Reuben's tonight, which is basically corned beef and sauerkraut and all that stuff. So
no, I love corned beef.
Sounds good. All right. So what are we diving into here? What do you want to talk about?
Well, we can touch on rates first, then roll right into kind of the whole inflation business.
Yeah. Yeah.
So
tell me about the rates. Where are they at?
Well, as people may know, the Fed increased the interest rates by a quarter. It's not going to kill us right now, but long term, we're going to start seeing rates keep climbing.
Mm-hmm.
And so we've gone up a little bit since we last spoke. We were probably in the low 4s. Now we're mid 4s and higher.
Gotcha.
So they are creeping up.
Mid 4s.
Yep. Which is, again, not running for the hills. I think we can show everybody the reason that it still makes sense. And there's other ways too. There's ways that we can lower it. When you call me, we can talk about bi-monthly payments, which will lower your interest rate no matter what interest rate you get. So it's not doom and gloom.
No, it's not doom and gloom. And there's a chart that we can show. You want to show that chart right now? We'll show let's show the mortgage rates for the year, the yearly mortgage rates, if we can do that. We'll put that up on the chart here. And for podcasts, what we're doing is we're just trying to show you that this is not the worst thing in the world. We're okay. The interest rates, which I thought was Justin and I were just talking about this. Yeah, this graph here does show 2021 as 2.96% as the average. Now we know that right now it's way higher than that. So it's at 4.5%.
That's good.
That's okay.
21.
It's okay.
21 was
and we're talking averages too.
Yep.
Okay. So what I wanted to bring up, though, if you look from 1992, which is when I got in the business, okay, and you go to 2020, okay, we'll just go to 2020. The average interest rate was 5.97. Okay, that was average for the years across those years. What was amazing was when it went to 72 up to 2020 was like. 1972, to 2020, it was like 7.96%.
Right. And that seemed low to me, to be honest with you, because of the days of 16s and 15s. But
yeah. And you know what? What's really cool is that from 1972 to 2022, there's houses still selling.
Yeah.
And they always have sold. So the interest rate is not what dictates the market.
No.
Okay. And there's no reason to get scared about it.
No.
Okay. I think the thing is what you should be scared of is a 15% credit card.
Well, yeah, that.
Or 9% car loan. That would scare me more than anything because those aren't good investments.
No. And you're absolutely right. There's other ways to lower those. So you do need to be looking at your full financial picture.
Mm-hmm, absolutely.
That's exactly what we do when we get together. And I talked about that last time, good debt, bad debt.
Yeah.
So these are good debts. So not only, you're not even taking into consideration the interest rate write-offs from that. Remember?
Yeah.
You're exactly deductible.
So right. We didn't even bring that up. You're exactly right. That interest that you're talking about, as that interest rate goes up, that's just more that you can write off on your taxes. Now, talk to your accountant about that. We're not experts in accounting, but
not everybody can write it off. As you know,
depends on your income and things like that and how much you already wrote off on other things. So but yeah, it's there.
For the first-time home buyer, that's huge.
Here's another one. Just think of this. I didn't even think about this till now. So, okay, the rates are at 4.5% this year, right? So you buy a house right now at 4.5%, right? And at the end of next year, we find out that the housing prices on the house you bought went up 10%. you paid 4% in interest, and their house went up by 10%, you made money.
Yeah, you made money.
You made money.
If you put less than 20% down,
yeah,
it keeps going up a little bit, or you put 10% down, it goes up 10%. Guess what? You're getting out of your mortgage insurance, which
absolutely
refinance. So it's yeah, there's a lot of positives.
A lot of positives. That's exactly right. So let's go into
I want to see that inflation.
You want to see the inflation thing? That is really good.
I think that's cool.
A great slide. And for anybody on podcast, we'll try to explain here what is going on. So this is a really cool chart. It was actually a chart that's from Keller Williams from down at our convention down in Orlando, Florida. And basically what it does, it puts affordability in perspective. So everybody talks about inflation. What I want to tell you is that a car in today's world with inflation has gone up 30.22% since 1989. Okay.
But there's also a lot more bells and whistles.
Absolutely a lot more there. Gasoline has gone up 56%. And that graph was made when gas was $2. When gas was $3.51. That's what that graph was made 99%. For. This is the one that is most important, is the house one. If you bought a house in 2021, which is last year, the average was $346,900. Okay. The payment on that was $1,455 a month. All right.
National average?
Stick with me. This is a national average. Okay. Absolutely. Yep. So it's $1,455. In 1989, that house would have been $94,000, or the mortgage payment would have been $825 a month.
Right.
Okay. If you inflate this, or if you use the adjustments for inflation, that would come out to $218,000, $218,232. The mortgage payment should be, when adjusted for inflation, the mortgage payment should be $1,915 a month.
Right.
Guess what? It's only $1,455.
Yeah.
So what's really amazing is that mortgage payments for the same house, adjusted for inflation, have gone down 24%.
Yeah, and
this is the reason we have a lot of buyers in the market.
Yeah.
Think about it.
It's affordable.
You're buying more house for less money.
I would like to, and I know we can't do it now, but rents as opposed to
rents
that, I wonder what
out of control.
Wonder what a rent inflation wise would have been, because to me they don't fluctuate as much.
Right. They're starting to.
Okay.
They're starting to. You're right. It used to be more of a level playing field.
$800 got you $800 worth of a rental.
But that's because there was vacancies.
That's true.
When you don't have vacancies,
probably,
same as housing, it goes straight up. That was a little whistle I did. You like that? It goes straight up.
The demand, right.
Because right now, if you talk to anybody in Wyomissing, like the ones that above where Viva used to be, and all those apartments and stuff like that, all the ones over in West Reading right now are pretty much 100%.
That's insane. Because
in fact, some of them are 105%. And you know why? There's a waiting list.
Wow.
Yeah.
So all those above like B2 and all that
stuff is 100%.
Wow. When they were building those, I'm like, who's moving?
Yeah, Metropolitan. As far as I remember, last time I talked to Kevin, 100%.
Viva, all above.
Yep. And they're not cheap.
Yeah, no,
they're not cheap.
They're not.
No. So that's the reason, but here's the thing, is funny is that they're going up, but there's no investment. The problem is that there's no investment there. No, it's completely, you're paying their mortgage. You're paying somebody else's mortgage.
And I'm assuming there's an HOA of some kind, like a condo association fee.
Oh yeah, and actually a lot of those places have all kinds of other fees, that go along with that. So
no write-offs, no.
So that's where we're at with that. So I love the inflation thing. That made a lot of sense for me when I was down in Florida, and I wanted to bring that up because I knew it would blow your mind.
No, it ties right.
And that's a good thing for you as a mortgage lender to say, hey, we're still doing really well here.
Yeah, here's the difference when you're talking with a first-time home buyer. They don't care about 90s rates so much.
This is true.
All they know is 2% and 3% and 4%. So it's a little bit harder, but again, that's more ammunition to show them. Listen,
show them the graph.
Like it, but it's where we're at.
Yeah, absolutely. So, but here's the thing too: don't let the media tell the story. You tell the story.
Yeah, do
you know what I mean? The media tells a bad story always. They're always looking for the worst news out there.
And talk to the experts. Don't go into, no offense, don't go into a branch to get a financial specialist opinion on the mortgages or the you don't go.
Yeah, don't talk to your tire guy for mortgage information.
Go to the right people.
Absolutely. So what else you got for me?
Well, I just wanted to touch on a lot right now is people are trying to find different ways to get approved. I'm finding a lot of people, because either they were out of jobs or not working as much over COVID. We have guidelines to protect them now, but I'm seeing a lot of cosigners right now, and
Interesting.
it's not a bad thing.
Why cosigners?
Well,
what do you think? What's the reason for that?
Debt mostly.
Debt.
Yeah, debt mostly, because when they were out of work or not working as much, they had to live off their credit cards. So now what's happening is their debt to income ratios are a little bit higher. So one way we're trying to let me start over. Let me start by saying my job is not to decline you. My job is to try to find a way to get you a mortgage and get you into a house.
Gotcha.
Not oversell you on a mortgage amount, but get you into a house so you're seeing all those rewards as we just spoke about. So when you come to me, we're gonna investigate all avenues. So a lot of times cosigners are coming up because mom and dad want to help out.
Sure.
You know, mom, dad, grandmother. It can be any family member.
They need to know what they're getting into, though. That's another point. Go ahead. Keep going.
Correct. No,
just want to make sure bring
that's
that up.
Huge. Absolutely. So the one big misconception is that you need somebody with great credit, which you do need somebody with good credit, but it could be a family member that has credit that's just a little bit better than yours, because guess what? We're using the lower of the two. So if you're a 700 and they're an 800,
you're using the 700.
You're using 700.
And the interest rate's going to be based on that.
Correct. So if they have great credit, unfortunately, it's going to help.
But 700 is still good.
Heck yeah.
Yeah. Okay.
Yeah.
Just making sure.
So what we're looking for in a cosigner is somebody that has a low debt ratio. Okay. And they have decent income. Their debt to income ratio should be, lower to support your higher debt. Now, what you just said, important to realize that they are in it. They're not just a bystander with, making
There's no such thing as a co-signer, although they're co-responsible.
Right.
But it's not 50%. They don't just, they don't know. Or if there's 3 people, it's not like it's split up third, and third.
No, that's your 100%.
Everybody's 100% responsible for that debt.
Correct. Now, there are ways in the future that if you pay your mortgage, mom and dad are in a separate account, you pay it all on your own, and we can show you can look to offset that after 12 months payments, but don't think about that now.
Yeah, exactly.
Because what we're trying to do is we're trying to get you in a position where you're in the house, and then we look to get them off as soon as possible. I have a lot of clients that I keep a tickler of and say, okay, Mr. and Mrs. Smith, Mr. and Mrs. Johnson want to be off this as soon as possible.
Right.
And not only that, I'm going to try to time it so when we're refinancing them off, we're also hopefully getting you out of mortgage insurance. So we're not just doing the paying closing costs just to get one thing taken care of. Let's get a couple things. Now, the rate might be a little bit higher. We're going to have to live with that. But again, it should only be a part-time ad, and now you're building more income, you're paying off debt, you're getting to be in a better position financially, so we can look to take them off. It might be your second home that they come off, and now you've built equity into that primary, but it's just all I'm going to try to prove you. That's the bottom line, is you're going to come to me, and I'm not going to try to say, you can't do it.
You're more the other way. Let's find a way to do it. Let's not say why you can't. Let's say, okay, here's the thing. Let's dissect this a little bit. Let's look into it and go, okay, here's where you need help. What can we do to outweigh this? Now, if it's a major credit problem and they want to be on the mortgage, they're going to have to work on their credit.
Yeah, no doubt. And I still think that they should do that, and I'll give them some education and some tools and some resources to work on their credit. But let's get you in the house. Let's get you started building equity. Now, the other thing I see is people are afraid to ask.
They're afraid to ask
a cosigner. So I have a client that's perfect for it. He's moving to the area, and he has a sister that's well-to-do, and she'd probably do it in a drop of a hat. She loves him, but
doesn't want to ask.
He doesn't want
to ask. It's but I get it. It's hard to ask for money. I mean, it's hard to ask for money. It's hard. It's also, here's the thing too. You're exposing yourself. It's not asking for money. It isn't and isn't. You're asking for somebody to come to the plate and be responsible
for you.
For you. Exactly. And also what it does, exposes yourself to letting them know that your credit is not good. You know what I'm saying?
Yep.
That's the other part. It's not as much as just asking, but now I'm admitting that I have a credit issue to somebody that I know and care for, or that I'm close with. And they're going to look at me and go, oh, well, how'd you get a credit problem? What's wrong with you?
Well, it's got to be somebody that you know and trust, probably. To be able to open up. Now, on the flip side, you do want to be careful, though, as a cosigner, because I've seen people get burnt.
We've had that happen, you and I. There was somebody that happened to. I can't remember who it was, but well, we wouldn't say their name anyway. But. No. There's a thing called confidentiality. We always talk in in very vagueness. So Bob, no, just kidding.
No, so you got to be careful because this person was not a homeowner.
Yeah.
Co-signed.
Yeah.
Tried to get a home. Found out that the mortgage wasn't getting paid. And it was horrible.
Not good.
And I had to be the one that delivered that bad news.
The bearer of bad news. The Grim Reaper.
Horrible.
So what else you got to go on? Believe it or not, we're at 15 minutes already.
Yeah.
And we're going to have to soon wrap this up. What else? Was there anything that was real pressing that we wanted to go over yet? Oh, I know. You know what? Hugo had a question.
I have a question.
Hugo's question of the day. What is your, this will be the first time we're going to let him ask a question. Go ahead.
So this question I had is like, whenever the square footage of a house is given, is the basement included in that square footage?
Is it supposed to be? No. Okay. Is it? A lot of times, yes.
What does the law say? Is there any regulations?
There's no law. There's what's supposed to happen. Anything that is underground, even a bi-level, anything that is considered underground, if it's finished, it must be noted as underground square footage. Okay. And it's not the same price per square foot when the appraiser takes that either.
Wow.
It's a lot less. It's a lot less. I finished my basement and we went and refinanced a while ago after we had finished the basement, and I was very surprised to see what you get for your basement and square footage.
Because when you get taxed on that, when you go to adjust your taxes and pull permits, it's not like they're giving you half credit.
No, definitely not. No, it's you know, like I always tell people, if you finish your basement and you spend $70,000-$80,000, don't be surprised if when you get appraisal on that, they give you maybe $16,000 to $20,000 of value.
Wow.
Yeah, so it's a personal enjoyment type thing, not really the best investment. Now, once again, if you go into a community where everybody has their basements finished, then it's a saleability factor, and you're gonna have a hard time selling it. So will that lower the price? Yes, it will. So there's a lot of things. But to answer your question, Hugo, for Hugo's question of the day, it is not considered to be the same as first and second floor. Okay.
Thank you for your participation.
Right. Yeah. Hugo. Thanks for your participation, Hugo, and you get a prize. Actually, you get nothing. Just saying. So that's pretty much it. I think we're good though. We're good. I think the rate thing was good. I think the inflation thing is huge, right?
Yeah.
Huge. Yeah. You know, it's always good about putting things in perspective. You know, and just be careful how much you listen to the media. Our industry's going fine. Rates are going up a little bit, but let's not cry about it. It's not that big of a deal. You can still buy a house, and there's still plenty of homes out there, and I think things are just going to keep getting better and better. So, all right. Thanks, man. All right, still